Well, for more on the markets, let's welcome Mike Dickson. He is head of research at Horizon Investments. He joins us now from Charlotte, North Carolina. Mike, thanks a lot for joining us. I've talked to a couple of investing professionals this morning who think that markets have become numb at the regular announcements and the shifting announcements that we get from the White House on tariffs, and that perhaps markets are complacent in the face of what could be real threats to economic growth around the world from U.S. tariff policy. Do you agree?
I would say I largely agree with that. I mean, look, we've just come off the fastest recovery in history for any market pullback, over 15%. And that, of course, was a man-made problem with these tariffs, and has quickly been recovered from in market pricing. And look, I mean, just valuations are a great way to measure the amount of risk that's kind of priced into assets. And believe it or not, valuations are above kind of where we started the year, really suggesting, like you said, the market has been really desensitized to a lot of this back and forth, and overall, I do largely agree that the reaction to this, back and forth, tariff announcements is extremely muted right now. And, for the most part, has been largely priced out of the market. And so that definitely makes for an interesting setup with what's now been pushed out to this August 1st deadline. I think there's going to be a lot of back and forth there. And I do think the implication is, a lot of these types of pullbacks that we're going to see from these deadlines approaching and new threats coming onto the table, I think those types of pullbacks should be tactically bought. Is ultimately, I do think what we're going to get are some deals that are going to be for the better ultimately. Okay,
and I see that some of your recent commentary, you characterize the upcoming earnings season in the U.S., not far away, as an important major test of hard data. How high are expectations set for S&P 500 companies, and what will we have to see in terms of earnings and guidance for markets to push higher?
Well, look, I mean, just right back to what I said about valuations as being that, excellent, sentiment measure of kind of where risks are in the market. It's kind of hard to believe that, we're actually kind of above levels where we are to start the year, given everything that's happened. And we also have not seen valuations go up because there are rate expectations, coming down due to the Fed. And so that means that for the markets to continue to grind higher from here after just a fantastic recovery in the last 2 months, we're going to have to see some serious upgrades on the earnings front. Otherwise, it's going to be really tough for valuations to continue to expand and, continue to carry the torch to new highs. So we're going to need to see this hard data. We're going to need to see, the guidance that we actually, did see a little bit more guidance than we expected last quarter. We're going to need to see, some really strong firm upgrades, in these earnings numbers. Otherwise, we might kind of be in for a little bit of a ceiling for the next couple months in the market.
And you believe that investors, and you speak mainly to U.S. investors, need to be looking at non-U.S. stocks. They need international exposure.
I really do. I mean, you've had obviously this just secular tailwind to U.S. growth for years. And we've really seen that turn around a good bit this year, in large part due, to a weakening dollar. And I think just with policy divergence here with the U.S. Fed and the rest of the world, you're likely to continue to see that tailwind. And then just looking at the valuation gap, there tends to be tremendous opportunity in international markets as it relates to that valuation gap. And I think that's a place where investors are probably best served to look to put new money to work. The U.S. has been quite a crowded trade for a while, and for good reason. But again, where kind of valuations sit and the kind of recent flows with the U.S. dollar, I think that international makes for a great use of new capital and is really due for a pretty secular catch-up trade that's been underpriced for years.
Meanwhile, it's been the mega cap tech stocks that have pushed the markets higher again. What is your view on the tech stocks, particularly those big Mag 7s right now?
Well, we've seen a pretty large divergence in the Mag 7, this year. So I don't think the Mag 7 is necessarily just the complete block trade that it has been for the last couple of years. There's quite a few of those names, that are down 15, 20% on the year, and quite a few that are up. And I think being selective with the Mag 7 and the mega caps, and in particular, just the AI theme in general, is kind of where the next leg of that trade is. So look, I mean, if U.S. markets continue to new highs, you're going to have some of those magnificent seven names leading the charge. I mean, the profitability and growth and exposure to AI they have is enormous. But additionally, looking down the CAC spectrum in software and services names, these kind of names that are able to really bring some revenue generation with a lot of that AI productivity, I think is where the next leg of that trade's going to be. And, overall, that's kind of a broadening out trade. And I think, that combined with, the international market opportunities really means that I think diversification is back. And I think we're going to see that rewarded the second half of the year.